Hello to everyone listening to our Active Investor with SGH podcast. I'm Rob Hogg, Head of the Individual Portfolios area and Chief Investment Officer at SGH. And this podcast is being recorded in Melbourne on February 18, 2025. Now, joining me today are Tim Gough and Stratton, both portfolio managers in the SGH Individual Portfolios team. Welcome, Tim.
Thanks, Rob. It's a pleasure to be here. This is my very first podcast, and hopefully there are many more to follow. And it's also great to be here talking with our clients.
Indeed. And welcome, Stratton.
Thank you for the invite. It's lovely to be here. Very excited.
Tim and Stratton have many years' experience in the industry and are responsible for managing client portfolios and relationships at the SGH Group. Now, in today's podcast, we'll be discussing a range of things. We'll start off talking about the RBA decision, which occurred just this afternoon. We'll talk about current market dynamics, including the rate cycle and equity market performances. We'll talk about some of the early trends in the February reporting season. We'll talk about the positioning of client portfolios and what type of market and macro environment would ideally suit that current positioning. And we'll talk about whether there are implications from the RBA's decision today. As well, we'll talk a little bit about the Trump administration, what are the implications, importance of China to Australian investors and the Aussie financial markets, and a little bit about American exceptionalism as well, and other things that pop up along the way. But look, I'm just going to kick off just with a few thoughts about the RBA decision just this afternoon. As I'm sure you all know now, the RBA cut rates by 0.25% to 4.1%. And that was pretty much universally priced in by the market. However, having made that cut, the RBA then went on to express a bit of caution about the scope for further rate cuts. For example, they said, while today's policy decision recognises the welcome progress on inflation, the board remains cautious on prospects for further policy easing. And then later on in the press conference, the Governor, Michelle Bullock, went on to say that if monetary policies ease too much too soon, disinflation could stall and inflation could settle above the midpoint in the target range. And in fact, during the press conference, the Governor spent quite a deal of the time trying to talk down or walk back market expectations for a number of further rate cuts. So why is the RBA cautious about the prospect for further cuts, having made their first cut today? It really boils down to the labour market being tighter than the RBA thought. And I think labour market conditions have probably surprised almost all of us in terms of the ongoing rate of growth in employment and the fact that unemployment remains really relatively low given what we've seen in terms of policy tightening. So the RBA is saying that the outlook's uncertain. The RBA is saying that they're cautious about further rate cuts. What was the initial market reaction? Well, look, just in the first couple of minutes after the decision, we saw the Aussie dollar rise a bit. We saw interest rates rally a little bit with tiny falls in 3 and 10-year futures yields or rises in 10 and 3-year futures prices. Equities moved up a little bit, but then shortly after that, really most of these markets reverted back to where they were prior to the announcement. So I guess that reflects the fact that it was pretty much as expected. And I think what you might describe as a hawkish cut, i.e. cutting today but cautious about further rate cuts, was not that far away from market expectations. So key will it be one and done as far as the RBA is concerned on rate cuts? We might now just turn to talk about rate cycles and equities and what sort of dynamics in rate cycles are important and equity markets, and how do equity markets often perform during rate cut cycles?
No, it's a really interesting point you make, Rob. I think it really depends on why interest rates are really being cut. If you look over during times of great stress, great example is the GFC or the pandemic, or you have a situation where a recession is the reason why they're cutting rates. It's usually a negative time to have equities. But if you have a Goldilocks scenario where the central banks can slowly reduce interest rates over time, that's a really sweet spot for equities as corporate earnings can generally increase during that time. And then also some of the valuations can actually rise on the back of it. So I would assume if the RBA continues to reduce rates and we avoid any kind of recession, then it's going to be a fairly good time for equities going forward, albeit, valuations are still pretty expensive, especially when you compare it versus historical levels as well.
Thanks, Strat. I think that's generally what we sort of see globally as well. If central banks are cutting rates, usually because inflation's a little bit lower, as long as we avoid recession, that can be an environment that's supportive for equity markets. So that seems to be the outlook that we're facing here in Australia presently. But right in the here and now, we're in the middle, really, of the February reporting season. So can I ask the two of you, maybe Tim, if we kick off with you, about observations of reporting season? I know it's barely even half over, but is anything interesting that you've seen?
Thanks, Rob. I think we're getting the normal series of reactions to results that we've seen in the last little while. And this typically happens when markets have had a strong run and expectations are high coming into the results. If you disappoint, then the market can be fairly brutal on the day of the result. Now, this doesn't necessarily play out in the subsequent days, but we are getting quite a bit of volatility through reporting season. Disappointing to date has been some of the healthcare names, the biggest one being CSL, particularly around its Seqirus business, the flu vaccine business, missed on expectations there. It feels like the market is still getting its head around the post-pandemic environment there and what the normal run rate is. There's certainly been a pushback at the consumer level around flu injections and the take-up rate of those. But there's a couple of things happening, obviously, around bird flu in the Northern Hemisphere at the moment that could see a sort of normalisation in the second half. But the reaction to that result has been fairly mixed, leaves the stock trading at a reasonably attractive multiple and still offering reasonable low double-digit sort of earnings growth for the years ahead. Similarly, Cochlear, which is probably at the other extreme of the healthcare sector, was also weak around the result, where its services revenue missed. But Cochlear, unlike CSL, trades on a much richer multiple, so a little bit more sensitive to a miss on earnings in that respect. You mentioned rate cuts. It's fair to say that that's typically not good for the banking sector, and they sort of all alluded, the banks that have reported, CBA's reported, Bendigo Bank, as well as Westpac's had its quarterly, and we get NABs tomorrow. But we know that bank rate cuts aren't great for margins. But to your earlier comments as well, we've had one rate cut, and I know it's the start of a potential cycle, but we've got to put that into the context that we had the equivalent of 17 rate hikes prior to this from the lows of the pandemic. So I'm relatively comfortable with how the market should perform at this early stage of the cycle, given what you've said about the risk around just the timing of when the second rate cut may be, or if at all. Strats, anything else on reporting season that you're seeing?
Yeah, it's still early days, Tim. Probably one of the themes that we've seen a little bit is the weak consumer. Consumers are very cautious. Companies are pointing this out. While revenue is still relatively strong, a lot of it's still from inflation still coming through. But when you look at the underlying volumes, they're relatively weak. And many companies have actually pointed out the weakness in Victoria and also across the sea over to New Zealand being in a very tough spot at the moment. So they're probably the other themes that I would see as well.
I can talk about the resources stocks as well. A lot of inline results there. What we are seeing in some of the resources stocks is that there's been a change in the emphasis. A lot of the upside in that space of the last couple of years has been around higher commodity prices, and that's driven strong free cash flow generation, which has been returned to shareholders. We all know the challenges that China has had in the property sector in the last 12 months, and we've had a much more mixed period of returns for commodities. We're now seeing the operating cash flow return to normal levels, but we're also seeing the added pressure of resource companies start to reinvest in growth and some pretty big projects on the horizon. So there's this trade-off now between returns to shareholders and reinvesting in the business, and the market's got to get comfortable around a lot of the company's ability to execute in that area. So again, getting some mixed reactions in that part of the market.
I find it a little bit comforting as well is that we are starting the interest rate cutting cycle when we don't really have an uptick in bad debts, and mortgage delinquencies probably haven't risen to a level that is worrying either. So that's probably positive for the underlying economy as well.
Yeah, banks are very comfortable with the level of credit exposure and the performance of their loans. In fact, they've almost got the opposite problem where people have been saving a little bit too much money. There's too many accounts ahead with bigger buffers on their loans, so that's become a bit of a cost on the funding side. I would say one of the sectors that's actually doing really well in reporting season is the gold companies, and that's probably no surprise. We've got a US dollar gold going through $2,900, and the margins that these companies are making on their cost base is significant. So most of the gold sector is making hay while the sun shines at the moment, and ultimately that feeds through to really high quality balance sheets and returns to shareholders.
Great. Tell me, once we get to the end of reporting season, are there any clear hurdles you'd like to see the market have got over? Any clear signals or any uncertainties on which you'd like to see perhaps a little more certainty than you presently have now? Strat, you were talking about the consumer, and presumably as we move through reporting season, one of the important and interesting things will be to see just how the consumer is coping. Are there any other things that spring to mind that we're hoping to get more clarity on over the next couple of weeks?
I think it's basically just the underlying trajectory of the economy and where it's really going. I mentioned the consumer again, and it's interesting that after the RBA put out their rate decision that all banks have come out, the major banks anyway, have come out and reducing rates straight away. And I think that will have some positive aspect, but it's really only one rate cut, and you would normally see a number of rate cuts coming through. I think what the market is really looking for is really earnings growth and margins to stabilise. And then if you start to see that, then you might see share prices come up a little bit more. But there's just a bit of a question about the strength of the Australian economy over the next 6 to 12 months, especially as we go into an election and as we reduce the number of intakes of student visas and immigration to Australia as well, which has really pumped up a lot of the growth that the economy has had.
Perhaps the thing I'd add in there, Rob, would be clearly we're in an election year. We've got an election cycle coming up in May. There's always a risk of some uncertainty creeping in. So I think the focus also got to be on which companies are in this, what we call the second half club, expecting big second halves after the first half. And so probably assessing where the mix of companies sits at the end of reporting season would be key. And then the other factor would be really what's happened externally, in particular in the US, and I know we'll probably talk about this later, but we've come into 2025 with probably a wait-and-see approach a little bit, and so the more and more clarity we have over the policies that President Trump plans to implement, and the news is flowing daily and weekly at the moment, so an opportunity for all the companies to actually comment on that is important as well.
And just on that, Tim, you make a good point about some certainty to come through. And a great example is one of the parties within Australia has talked about potentially breaking up the insurers, and that was probably very new news to the market. And so we've seen some of these shares sell off on the back of that. So if you see any other aspects to that, it can provide some kind of negativity or some volatility within certain sectors if we see it spread to other areas.
Great, thank you both. Look, could we just spend a little bit of time talking about how the portfolios are currently structured, how they're currently set up, and what sort of environment would most ideally suit the current settings?
I'll kick off, Stratton, and you can probably add. I know we do run slightly different portfolios. I mean, one of the key components of our individual portfolios business is we tailor the portfolio to the individual client, whether that be income objectives, capital objectives, a bit of both. But generally, they're all managed in an after-tax fashion. The way we're set up at the moment is conscious of valuation in the market. As we know, risk premium are very low and historical valuations are relatively high. So we're a bit cautious around paying up too much for growth. That said, we're not completely devoid of growth in our portfolio, but we're just conscious that some stocks have become a little bit stretched. And we're also conscious where the banks have had a strong run over the last 12 months. Banks outperformed resources by 54% to 31 December, which is quite an extreme variance given they're the two largest sectors in our market. So we generally are underweight banks. We've been underweight resources as well, really around Chinese uncertainty, in particular the lack of follow-through on recent stimulus announcements, how we haven't seen much of a response in the commodity prices, and so that uncertainty still remains. As I said earlier, we're overweight gold in the portfolios. Where we've been getting a bit of our defensive exposure is probably through the infrastructure stocks in the market. We've seen the traditional defensive stocks as quite expensive, and so we've seen a bit more value in infrastructure. The likes of Transurban, Atlas Arteria and Chorus, the New Zealand equivalent of the Australian NBN business, which is listed in the market. They should benefit a little bit from a rate cut as well, being generally longer duration stocks.
Yeah, especially if you start to see the 5 and 10 year bond start to come down over the next couple of quarters as well. That will create an opportunity for some of these stocks to rally on the back of that. I'm reducing the level of beta in the portfolio by selling a couple of names which have performed particularly well and buying more defensive stocks, especially as Tim mentioned, the infrastructure names look quite attractive at these levels and similar to some of the listed real estate stocks are looking more and more attractive as well, given their payout ratios and the expectation that cap rates could actually compress if longer-term interest rates start to come down. When it comes to income, for clients who are looking for income, it's becoming a little bit of a harder space just because credit spreads have contracted quite a bit over the past 18 months. And if we go into a time where interest rates are steadily declining, it makes life a little bit tougher versus what we've seen over the past 2 years. But it's infinitely better than where we were just post the pandemic when interest rates were effectively at zero. So that's how I'm positioning the portfolio at the moment, the changes that made of late.
And tell me, guys, we spoke earlier about the RBA. Does the rate cut today, perhaps not another cut for some time, does that really change any of your thinking?
Well, for me, it doesn't really change too much. As you said at the outset, Rob, the rate cut there was a 90% probability of the rate cut going through from markets. So when it did go through, we saw some sectors move around a little bit, but it's not going to change too much about how I positioned the portfolio. I think, as Tim said, if we see a couple more rate cuts, that's going to be pretty negative for banks. And when you look at the returns over the last 12 months, banks have been the second best performing sector outside of IT, and that sector within Australia is quite small.
Yeah. And you mentioned banks, but also the consumer discretionary sector, which has been one of the strongest performing, has been underpinned by Wesfarmers. If we are going to get limited rate cuts, then a lot of the good news is factored into these stocks already. So you might see some softness, and I think that'll help us in the way we've constructed our portfolios more recently.
Really no podcast at this time of the year with the new presidential administration would be complete without talking about the new Trump administration at some point. Can I just ask for your reflections on that and what the implications could be and what we've already seen, perhaps?
It's the biggest question in town, Rob, isn't it? How to think about Trump and how to react. And I mentioned our sort of a wait-and-see type sort of approach. I think trying to predict what Trump does is near on impossible, but maybe we need to think about how other countries and regions around the world are actually going to react, and that might give us a bit more of an insight. And so I think some of the noise coming out of Europe and some of the noise coming out of China suggests that there will be retaliation. We know in the case of China that if Trump is to impose all of these tariffs as he is, then that growth objective they have is quite important to them. 5% over a sort of 5-year sort of period, and when we know they're midway through that cycle, they will need to stimulate to offset the impact of tariffs on their export economy. They'll need to stimulate in that domestic consumption market, and that may well have some benefits for us as an economy if we do see sort of spillovers into the infrastructure and even the property sector, which we know has been on its knees for the last 18 months. That would be very supportive of our commodity space if we're to see that, I think. Look, trying to predict, we go to bed every night and you wake up and you're looking at the headlines just to see what's happening. But we know it is about the art of the deal for Trump, and it started off with his comments around tariffs on Canada and Mexico, and then the next day they were all put on hold for a little bit. There's a lot of negotiation going on. It does strike me that one man has way too much power in the overall setup in the US of the economy at the moment. But that's what it seems like at the moment. But we do know there are some guardrails under which the framework should work, and they'll be put to the test over probably a longer period of time. Probably it's one of wait and see at this point, but we have to be attentive to what could be a pretty volatile period.
Yeah, I think especially with Trump, you've definitely seen him come out hard as Tim said, about tariffs across a variety of different nations and then sort of soften them back. And given how strong the US's economy is at the moment, he can really dictate a lot of the terms. And sometimes he probably doesn't even want the tariffs to come through, but just wants something else, whether it's more border control or bring more manufacturing over to the US. So I think it's very hard to predict what he will do, but it's one of those watching briefs that you're watching every day.
Maybe I should put that question back to you, Rob, and how you're thinking about the outlook for rates given the change in the US administration.
No, fair enough, Tim. And look, I might just venture back to a comment actually the RBA governor was asked about the potential effect of tariffs on policy and the economy, and she noted that the outlook for tariffs is both very uncertain and unpredictable. So, and that's obviously very clearly the case. But what has the impact been so far? It's been interesting this calendar year to look at the trends, and they're different to what they were in the lead up to the US election and then following the US election into the end of the year when this US exceptionalism really reached a peak. Moving into this year, as Trump was inaugurated around the middle of January and has started making all his pronouncements and executive orders and so on and so forth, we've actually seen the US dollar give up a little bit of its strength. We've seen US equities underperform the global markets, maybe because global markets were so negatively affected ahead of the end of the year. But we've also seen rate expectations move in the US such that the market's nearly completely priced out rate cuts. And that's mainly because activity in the US still seems to be doing okay. But I suppose one of the risks of Trump, given that we've all bought into the story of deregulation and tax cuts and all of the positives that could occur, and the market's moved in taking all of that in and priced some of that in, what is the risk to that view? Well, it is perhaps that there's uncertainty. We've seen in consumer confidence numbers in the US that inflation expectations have risen. We've seen that uncertainty has risen. And it would not be hard to imagine that corporate decision-making becomes negatively impacted as well by the uncertainty with the tariffs. In particular industries, certainly you'd have to think that autos were right in the middle of that. So I wonder whether after the initial euphoria in expectation of Trump and then following the election of Trump, all built on the back of tax cut and deregulation and so on and so forth, whether we're just seeing some sort of payback now for that, some of the potential downside and the volatility and the uncertainty. We know uncertainty is not good for markets. We know uncertainty is not good for corporate decision making. So we could potentially see a flip side to what we saw late last year.
And there's no doubt also that things as we've known it for the last 10, 20 years are changing. The trade is being turned on its head, and now the approach to defence spending is also going to be turned on its head, with certainly some of the indicators coming out in recent days. So, to your point, markets may not like that change. They don't like uncertainty, and we haven't necessarily seen that priced in to date, but there could be a time ahead where it changes.
And on the corporate side for decision making, a lot of times when you look at the supply chain, these are long-term decisions these companies are making. And if Trump is out there saying we're going to put some tariffs on, I'm sure some companies are going to start trying to look at how can we get this component differently, maybe from a different country or from a US, which then causes prices to potentially be a little bit higher, which then means inflation probably lasts a little bit longer lasts high for a little bit longer. So the expectation for interest rates, which we've seen, has completely come off, and so we see basically flat rates for the rest of the year. That while it is underpinning some kind of growth, it doesn't have the other negatives.
We did just touch on it briefly, but China, obviously incredibly important to the Aussie economy, to the Aussie equity market, and potentially right in the eye of the storm. How are we thinking about that, and what are the risks there? Is it possible, given that sentiment about China is really quite negative, that in fact this could be a catalyst to quite significant Chinese policy reaction to any Trump tariff increases?
Totally agree. I mean, I think we need to watch very closely the response out of China, given the weakness in economic growth we've seen out of China, and the fact that the US market is relatively expensive to a lot of the regions of the world, and China is one of those that has lagged. That, as you say, if things are less bad in China, then we may well see a rotation away from some of these outperforming areas into the underperforming areas, and it goes to that whole concept of US exceptionalism. It's been coined in recent years. We've had 2 years of very strong markets in the US. The reality, a third one will prove more difficult to achieve, and China could be one of those regions where we see a bit of reversion.
Tell me, guys, just trying to draw the conversation together and to an end as such, but also looking forward, what are the types of things, the issues, the policies that you're looking at, the market developments over the next quarter or so, to try and get a sense of how to be best positioned?
That's a good question. It's an aspect that we try to do every day, and given how we manage portfolios, while we do look at taking positions from an asset allocation point of view, we are bottom-up stock pickers for the portfolio. So we're trying to find those gems in the portfolio that have pretty strong earnings growth, that are attractively priced, and we look at valuations in a variety of different ways. But it's about constantly looking for those pockets of opportunity that we can potentially find. I think the election is going to be really interesting, especially as we go up towards it. Businesses are usually a little bit cautious when it comes to spending, so we may see a little bit of weakness in there. But after we have a decision, then that normally leads to business confidence rising. And after the election, we may have another interest rate decline after that, which could lead to a bit of positiveness on the consumer side as well.
I'm thinking about capital preservation across the portfolio in the light of this uncertainty that we're certainly seeing. We're seeing uncertainty around geopolitics and the US economy and global trade, as we've mentioned. So the risk that feeds through into the corporate level is high. It's high because the starting point for valuations is fairly stretched at this point in time. So I think as we think about client portfolios into the first half of the year, then capital preservation is quite high. Also thinking about coming back to what do? We invest in good quality companies that can sustainably grow at a reasonable price. And so, continuing to remind ourselves of why we hold certain investments in the portfolio, whether there's been any change in the conditions under which we do so. And then ultimately the other component is what's the level of income across our portfolios. Now, it's got harder, as Stratton said before, to find good yields in the market. But when everything gets a bit too volatile out there, one thing we always say to our clients is what keeps us sleeping at night is having good companies in our portfolio that will deliver very solid or high levels of income across the portfolios as well for them.
Now, tell me, if we can just come back to this issue of this US exceptionalism psyche that really took over markets at the end of last year. And interesting, I guess, as we moved into this year, we have DeepSeek as a potentially very, very, very significant event. Stratton, do you have a view on whether that has any kernel, any seeds, anything at all that could impact on the investor euphoria about US exceptionalism, which we most often see discounted in the prices and the thinking about tech?
Yeah, I think we definitely saw that across the tech space. When that came out, you saw a lot of the tech stocks sell off significantly on the back of it. And I think it really gets down to the point that the race isn't over. And I think investors, especially in the US, were thinking that the really large tech names were building this very strong moat around AI, that where they were spending billions of dollars in capital to work out the best way to implement it and to write the best code. But to think that if you believe that what DeepSeek says is just with $6 million in a couple of years and with only 3% of the power consumption of ChatGPT and other AI bots, that you can really get there. And it really brings me back to when I was younger and I used Netscape to surf the internet. And Netscape was the #1 web browser for a number of years. And even when you think of search engines, it was Yahoo. Yahoo was the #1 search engine. And then all of a sudden, this little company out of nowhere called Google comes out with a better algorithm and basically now has 99% market share and Netscape is no longer in existence. So I think it's very early to say that there is a very strong moat and that the jury is still out about who can really win the AI race. Now, a lot of the conversations I have with clients about how can I gain exposure to that space, if you're talking from an Australian context, there are little pockets you can gain exposure to, but it is inherently quite difficult to get exposure. And so there are other avenues that you can get exposure to through US funds and the like. There are some opportunities within the Australian space. One of the ways we have looked at it in the past was NextDC. While they aren't an AI provider, they do provide the data centres, the power, and the equipment behind everything so these AI chatbots can run. So it's going to be very interesting how it does pan out, but I think there's still a lot of water under the bridge to go.
I think it's really interesting. And by the way, Stratton, LookSmart was my search engine I used back in 1999, actually. So a little bit before, maybe before Netspace, I'm not sure. Might be wrong
I think
there.
I used Encyclopedia Britannica.
Well, and what's that one we've still got sitting on the shelves at home? Is that Encyclopedia Britannica? Or it might be. Yeah, anyway, US exceptionalism. Look, a couple of points I'd probably make there would be that it's a great reminder that what happened yesterday isn't likely to repeat. And I think we've had two very strong years, as I said earlier, of US tech stocks. Retail positioning in the US market is at extremely high levels. And if we see the entrance of new competitors into this space, whether it be DeepSeek or someone else, it's a reminder that the momentum factors that have been very strong, people buying what yesterday's winner was on the hope that it'll continue on, could well change the landscape. And what that comes down to is that there's about $1 trillion in capital CapEx about to be invested by the big 7 stocks in the US, and the current assumptions are that returns on that capital will be the same as they've achieved in the last $1 trillion. And that's unlikely to be the case. And so the market's landscape will change. New entrants coming in will accelerate that change. And given the positioning, we could very well see markets ripe for a correction there.
Well, that brings us to the end of today's podcast. We hope you've enjoyed the discussion about markets and how we manage portfolios for clients within SGH Individual Portfolios, and also some of our thoughts regarding current and prospective investment environment. Please subscribe to stay updated on our latest podcasts. You can find us on Spotify, YouTube, Vimeo, and Apple Podcasts. Follow us on LinkedIn and visit our website sghiscock.com.au for more information. SGH Individual Portfolios provides a service that is available to wholesale clients and is suitable for individuals, self-managed superannuation funds, family offices, trusts, companies, and not-for-profits, charitable and faith-based organisations. Clients delegate their investment decisions and the implementation of their chosen investment strategy to us, whilst retaining beneficial ownership of their investments.
SG Hiscock & Company is the investment manager of the SGH funds mentioned in the recording. The information in this podcast is for general information purposes only and is current at the time of recording. It does not contain investment recommendations nor provide investment advice. Neither SG Hiscock & Company nor its related entities, directors or officers guarantees the performance of or the repayment of capital or income invested in the funds. Past performance is not necessarily indicative of future performance. Please obtain detailed professional advice and to read the relevant product disclosure statement and target market determination in full before making an investment decision. The views in this podcast are those of the contributors at the time of publication and assume a certain level of knowledge. For more information, visit sghiscock.com.au.